What if you could generate monthly dividend income from just 3 ETFs while still keeping a diversified approach? In this video, I'm going to show you how. I'm going to weigh up the pros and cons and help you decide whether it's worth considering for your own portfolio. Getting monthly income outside of a salary can be a tricky task because most dividend ETFs will pay out either quarterly or semi-annually. There are some funds that pay out monthly, but they usually come with some form of quirk. Either they're not all equity, so they include some form of bonds. They use covered calls, which essentially trades capital growth for income, or they simply just chase yield, and in doing so pose massive risks. They also tend to be actively managed, with a fund manager smoothing out returns, but they will be more expensive, and actually when you look at the performance over long periods of time, they rarely beat their benchmarks. So the key with this strategy is to select typical passive dividend-focused ETFs that pay out quarterly, but in offset months. So because they pay out quarterly, you would select 3 ETFs. ETF A would pay out in January, April, July, and October. ETF B would pay out in February, May, August, and November. And then ETF C would pay out in March, June, September, and December. The hardest bit about this strategy is finding those ETFs with those offset months, because being a typical dividend-focused ETF, it's likely going to pay out its income when the majority of the companies it invests into also pay out. So it's going to match the schedule as best it can. But because it's dividend-focused, a lot of these ETFs can invest into similar companies. And I was finding a lot of the ETFs I looked at paid out in March, June, September, and December. But when a stock or an ETF pays out its dividend, is probably something you're not too bothered about if you're in the accumulation phase. But when it comes to taking income from your investments in either retirement or just as an extra income source, it can take some adjustment and some cash flow management, going from having that monthly salary to now having a quarterly payment that you need to spread out. So the 3 ETFs I found are the Wisdom Tree Europe Equity Income Fund with the ticker EEI. And this fund pays out in January, April, July, and October, having recently just changed from semi-annually to quarterly payments. Then we've got the SPDR S&P Global Dividend Aristocrats Fund with the ticker GBDV. And this fund pays out in February, May, August, and November. And the third ETF is the VanEck Morningstar Developed Markets Dividend Leaders Fund with the ticker TDGB. This fund pays out in March, June, September, and December. This fund, as the name suggests, focuses on developed markets, but more specifically on companies that have displayed consistency and sustainability with their dividend payments. We can then take that one step further with the Aristocrats Fund. This is a global fund, but it only invests into companies that have at least a 10-year track record of paying a growing or a stable dividend. Then the Europe Fund is a regional tilt to European stocks with high dividends. The key feature with this ETF is that it's fundamentally weighted. So that means instead of the market dictating the company's weight in the index, there's fundamental metrics that are used, such as revenue, earnings, book value, cash flow, and dividends. The aim here is to provide a more stable and value-orientated investment return. Across these 3 ETFs, there is reasonable diversification. You will get a small amount of overlap in some companies, as you can see from the top 10 holdings. From a country weighting perspective, the Aristocrats Fund is quite heavily weighted towards the United States. But then to counter that, the European Fund obviously has no United States in at all. And sector-wise, they are all reasonably spread out, although you could say that financials being top in all 3 funds would be a negative from a diversification perspective. They're all fairly close in dividend yields as well, and that's especially important if you want somewhat similar payments each month. Europe is a bit higher than the other 2, but you may also decide to have slightly less in this fund, as the other 2 are more globally diversified. The Developed Markets Fund has historically been a fair bit higher, but as you can see from the dividend amounts, it's not because the dividends have been falling, it's because of how much capital growth it's had. This fund has actually been on an insane run, 140% in the last 5 years, compared to 52 for the Aristocrats Fund and around 84 for the European Fund. Just to put that into perspective, a typical global ETF, I'm using Vanguard's fund here, has done 67.8% in that same time frame. This does bring about one particular downside though, and that's total return. In hindsight, you would have been better just investing into that Developed Markets Fund rather than spreading across the 3. Of course, you could have invested into any dividend fund and you wouldn't have known which one was going to outperform. But in bull markets like we've seen in recent years, both the Aristocrats Fund and the European Fund are unlikely to outperform because they focus on arguably higher quality and more mature companies. Where these 2 funds would likely outperform is where the market would be moving generally sideways or even downwards. Some of the other downsides to consider would be the payment date shifting. So like we saw with the European Fund, it went from semi-annually to quarterly payments. But these funds could quite easily go the other way as well, and they could also shift their months. It depends what companies are in the index, and that's continuously changing. It won't make too much difference in a total return perspective because you're still investing into the same funds. All it would mean is that you might not necessarily have those monthly payments, which may have been the main reason for going into these 3 funds. And you've also got to consider complexity versus just owning one fund. When you own just one fund, it's easy, it's hands off, it's almost set and forget. But when you own 3, it's not loads of work, but you've also got to think about rebalancing. So like we've seen in the last 5 years, if you went in equally 5 years ago, and now that developed markets fund has massively outperformed, would you let it run? Or would you rebalance on an annual basis? In hindsight, if you rebalanced, you would have been worse off than just letting it run. But you wouldn't have known that, and it could have then underperformed. So you have a bit more of an active decision to make. In reality, you would probably just set whatever your weightings are at the beginning on an annual basis. You just reset them back to those weightings. And the other thing would be that although you're getting regular payments, that doesn't necessarily mean it's stable. So those payments could be quite different from month to month, not only because they're from different funds, but also depending on the performance of the underlying companies. That's just part of the game with dividends. They're always going to be variable. And if you're just comparing this to owning one fund that pays out quarterly, when it's going to have exactly the same issue. So who might this approach suit? One of the biggest use cases could be early in retirement. Early in the sense that you're retiring before you can access your pension. So you need to cover that gap between your salary ending and you being able to access your pension. But it could also be early in the fact that, say you were able to access your pension at 57, you've then got to wait until 67 before the state pension kicks in. So again, you've got that gap to cover where this regular income could help to fill that gap. And this kind of strategy would definitely benefit from being inside an ISA or a SIP because of the difference between the dividend tax rate and the capital gains tax rate. You're taking dividend income rather than selling down capital. In an ISA, you're not going to pay any tax on those dividends. And inside the SIP, you will pay some tax, but because you get the 25% tax relief, you've got some form of shelter there. And the kind of people that this strategy probably doesn't suit is people accumulating in their 20s and 30s, people with that long time horizon. The main thing you're concerned about is total return. You're not bothered about income. You just want to compound over that long period of time. And it's also not going to benefit investors wanting guaranteed income. Although this strategy will help to smooth out those dividends, it's not going to be exactly the same each month. And it's also not guaranteed. If you want guaranteed income, you're essentially looking at bonds, money markets, or even just holding cash. And if you're in retirement, that'll be looking at an annuity. Let me know your thoughts down below in the comments. And if you want to explore what creating an income in retirement actually looks like, then watch this video next. Thanks for watching, subscribe if you're new, and I'll catch you in the next one.